Hello there. Welcome to Financial Accounting N6. We are still working on a paper from June 2023. This is question 3 that we want to look at now. The question 3 is on calculation of figures to be included in the balance sheet or statement of financial position. We are also going to prepare some notes to the balance sheet in the form of the order share capital note and also the trade and other payables note. So that's what we have on this question. And the question reads, the following information was obtained from the records of Dubs Safe Limited with the financial year ending 31 March 2022. So that's where our financial year is ending, 31 March 2022. Dubs Safe Limited sells new and used safe boards and offers safe lessons for which they charge a fee of 450 rands per lesson. And then next paragraph, Dubs Safe Limited is an authorized share capital of 1,000 shares. So this is telling us that this is the maximum shares that the company is allowed to raise in the form of 1 million shares. But we are supposed to have an issued component which is which should be equal to the authorized or less than the authorized. So let's see the next statement. 625,000 shares has been issued on 31 March 2021. So 625, you see 625,000 is a figure that is below 1 million, which is the authorized, which is appropriate. And then this is the balance that you are given on 31 March 2021, and you are seeing that the year is ending on March 2022. So this is 2021. So this comes as the opening balance of the ordinary share capital. Then at an average price of 3 rand 20 per share. So this is the average share price, and we know that the average share price is the one that is used whenever we want to make a repurchase. It's very important to take note of the average share price. Then next paragraph saying the figures already entered into the statement of comprehensive income are from the pre-adjusted trial balance on 31 March 2022. Then we've got an extract from the financial statement as at 31 March 2022. We are given that extract whereby we have got balances on 31 March 2022, that is the end of the year, and then we've got at the beginning of the year, this column, 31 March 2021, and then we've got additional information following that. Additional information is saying Dubs Safe Limited operates on a 25% markup policy on all sales. Last year, sales amounted to 800,000 rands. Dubs Safe Limited is pleased to announce a 10% increase in net sales in this year's financials. There were no debtors allowances for this year. So that is what we have on this page. Then we can move on to the next page to see. So the second one reads, after considering the financial implications that a buyback of shares entail, the directors decided on 1 January 2021 to repurchase 4% of the shares currently in issue. These shares were repurchased at 4 rand 50. No entries have been made for this transaction. So very important to take note. Remember, we have the average share price that we are given, that is 3 rand 20. This is the average share price that we are going to use when we are adjusting the repurchase in the ordinary share capital. But we are seeing that they were repurchased at 450. So what it means they were repurchased at a price that is above the average share price. So, but when we are adjusting in the ordinary share capital note, we are only concerned about the average share price. The excess of the average share price, we adjust it in the retained income note. So that's what we have. So for this instance, at 3 rand 20 is the one that we are going to use for ordinary share capital note. Then the difference between the two now, we are saying 4 rand 50 minus 3 rand 20. Then we get the difference there that we are supposed to adjust in the ordinary, in the retained income note. So if you subtract that one, you're going to find that you are going to get a 1 rand 30. So here we now have 1 rand 30. So this one is going to be adjusted in the retained income note. Remember, whenever there's a repurchase, it's an outflow of cash. So we are going to subtract in the ordinary share capital note using this average share price. Using this one is going to be in the ordinary share capital note. Ordinary share capital note. Here we have the ordinary share capital note. So that's the one that we are going to use in the ordinary share capital note. Then this one is going to be adjusted. The excess will be adjusted in the retained earnings. So we subtract this one, 1 rand 30 in the retained earnings, and then this one we use it to subtract in the ordinary share capital note. So that's what we have. But if you have an issue of shares, is the opposite. We now add. So the next one is saying same Safe Ski Limited has rented a storeroom from Dubs Safe Limited for 850 rands per month since 1 December 2021. So that's what we have there. And then we've got some other adjustments that we have that are following. We can check other information that we have beneath that. We can quickly move on to the question and try to see what the question requires us to do. We've got the question there at the end of this question. There are some requirements that are there. So if you move on to the next page, and here we are given a list of balances of the property, plant, and equipment in terms of the non-current assets that we have in the question. So if you move down, that's where we are having the question now on the required part. The required part is saying calculate the assets repurchased. That's the first part. And then we've got calculate the depreciation of own vehicles, calculate the proceeds of fixed or tangible assets sold. And then we've got also preparation of the following notes: issued share capital at the end of the year, and then trade and other payables. So the last part, we are not going to do it in this video. We are just going to end here in terms of this video. We end here on trade and other payables. So we go back and see what we can do in terms of the first part, which is to calculate the assets purchased. So we go to the non-current asset note that we are given. That's where we are going to have that information. If you come here, you would see that we are going to analyze this note from the financial statement of property, plant, and equipment and see which non-current asset was purchased and at how much. So if you look in the land and buildings column, we have got carrying value of 975,300, and we are seeing that there is nothing that in terms of accumulated depreciation, and we don't charge depreciation on land and buildings. And we are seeing there are no additions there. On additions, there's a question mark. Sorry, there's a question mark, but no disposals are zero, which means there were no disposals. But for additions, if there's a question mark, it means there's something. So it means that's the figure that we are looking for. Then we are given a balance at the end, and they're seeing that a balance at the end is more than what we have at the beginning, which means there was a purchase which took place there. There was an increase in value. Then if you look at equipment now, we have nothing in terms of additions. Zero, it means there's nothing. Zero means there's nothing. Then we also have no disposals. The same to vehicles. Vehicles, we have no additions. But we have got a disposal because there's a question mark, so we can take note of that. So the purchase that we have is only on land and buildings. So, but if you move down that note, you'd see that the first point is saying a vehicle was sold at carrying value on the last day of the financial period. That is going to affect the disposal on the disposal part. You want a purchase. Then depreciation on vehicles is provided 10% on the diminishing balance method. And then no equipment was purchased or sold during the year. You see, there's an instruction that there was no equipment that was purchased or sold, but there are extensions to land and buildings were made during the year. So the year is giving us a hint that the purchase took place in the land and building. So we are just going to subtract the difference between the balance we have at the end minus the balance that we had at the beginning to find that one. So this one is 3.1.1. If you see 3.1.1, it's asking us to calculate the purchase. So we are saying it's only on land and building. So we are going to say this figure minus this figure. So basically we are going to say 975,000. Sorry, we can start with the bigger figure there. So we are going to say 3,750,400. Then we are going to subtract what we have at the beginning, 975,300. Then we get the value of the purchase. So if we calculate that one, we are going to get 2,775,100. So this is the figure that we have in terms of 3.1.1. This represents land and buildings in terms of the extension that took place. So it represents the purchase of the non-current asset. So if you go to the second part of the question, we can move down. to recheck what actually is on the second part. Calculate the depreciation on vehicles. So we go again on the non-current asset notes and try to see how we can calculate depreciation there. But basically, you can go to the instruction in terms of the calculation of the depreciation. First point is saying a vehicle was sold at carrying value on the last day of the financial year. You see, that's where it is very important. It was sold on the last day. It means it stayed the whole year in the business. So the depreciation of that vehicle for the whole year was the expense for the business. But if this vehicle was sold sometime during the year, we are going to calculate the number of months that it stayed in the business. Then we make a proportion of the depreciation that we did find per year. If it stayed 3 months, we say 3/12 times the depreciation that we get per year to get the proportion of the 3 months. But really, we are being told that it stayed the whole year, so we are just going to do the normal calculation of per annum, and then the figure that we get is the one that is going to be charged to the income statement under operating expenses. So that's what we have. So we go back there and see what the depreciation is being calculated as method that we are going to use. Depreciation of vehicles is provided at 20%. This is the rate on the diminishing balance method. So this is the method that we are going to use for that depreciation. So this is now 3.1.2. Sorry, 3.1.2. So we are having here 3.1.2. So basically, diminishing balance method, we use that calculation, that percentage we calculate by the carrying value. Percentage we calculate by the carrying value. So we are going to say percentage times the carrying value. So let's try to see what we have there. So we say percentage of carrying value, but carrying value, we would find our carrying value as saying cost minus accumulated depreciation. This is the formula for finding this carrying value that we have here. So we first have to find the carrying value so that we calculate the depreciation for motor vehicle. So we are just going to use the figures that we are given there at the beginning. Because that non-current asset, the vehicle stayed the way, so we can check the figures that we have there in terms of we are seeing at the beginning for motor vehicles. Vehicles is in the last column, so we can say for the carrying value, we are saying the costs there we are given it is 382,800. Then we subtract the accumulated depreciation that we have at the beginning, 146,800. Then what we get there, this becomes our carrying value. So this becomes our carrying value. So what we are going to do there, you get 236,000. That's the figure that we get there is our carrying value. So this is our carrying value. Then we now say percentage times carrying value. We now say percentage times carrying value. So we are now saying our percentage is, remember, 20%, 0.2. Then we multiply by the carrying value, 236,000. So when we calculate that one, we are going to get 47,200. So this represents the depreciation on motor vehicles. So we go again to check the next question. What do we have? Right, on the next question, they are saying calculate the proceeds of fixed tangible assets sold. So this is our disposal that has taken place. So the explanation in terms of the disposal is here. A vehicle was sold at carrying value on the last day of the period. So the key term that we have there is that they were sold at carrying value. Carrying value, you know how to calculate carrying value. We are saying carrying value, you said is here, the formula is here, cost minus accumulated depreciation. So we can find the carrying value, and then when we find the carrying value, we know that that's the amount that was used to dispose that non-current asset. But the formula that we use, we can take it from the T account that we prepare using carrying values. We can take it from the T account that we prepare using carrying values. We can put it in the form of a non-current asset account. And then we put the value of the balance at the beginning, or we say balance BD, using the carrying value of the balance BD, and then the carrying value of the balance CD, that is the balance at the end of the period, don't use cost values, but use carrying values. And if there are any purchase, they come here. Any purchase of the non-current asset will come here. And depreciation for the year will come there. Depreciation for the year for that non-current asset will come on the credit side. And then the carrying value of disposal will come on the credit side. So this is the method that we can use. And we know that the figure that we are looking for is this one, carrying value for disposal. And all the figures we are given in the question. So it's a matter of just trying to see what figures do we have. So we go to the list of balances now to check those figures. If you come here now, you'd see that we are on vehicles, and vehicles is here. And you'd see that the carrying value at the beginning of vehicles, we are going to say 382,800 minus 146,800. So we can calculate that one by saying 382,800, then we subtract 146,800. Then the figure that we get there is 236,000. So it means here the carrying value that is supposed to be there is 236,000. 236,000. Then also we want to see the carrying value at the end. We say 172,000. 172,800, and then we subtract 83,000, and then we get what 89,800. So that's the figure that is supposed to come here, 89,800, right? So when you get these figures, we now have the carrying value at the beginning and carrying value at the end. And the depreciation for the year for vehicles, we calculated it there, and we found it as 47,200, remember, on 3.1.2. And we have depreciation, and we have no purchase that we are supposed to put on the debit side of that account. So we can put the figures that we have there in that T account. So we are seeing now we are here on that T account. So we are just going to apply what we have there. So we form another T account there to put those figures. Remember, the balance BD at the beginning, we found it is okay. We can check the figures there, or we can put the T account nearer so that we don't miss the figures. We can put it there. Right. So the balance BD at the beginning, we said it comes on the debit. So we say 236,000. 236,000. And then the balance at the BD at the end will come on the credit side is 89,800. And then depreciation for the year will come also on the credit. We found 47,200. Then the figure that we are looking for should be on the credit again, carrying value. So basically, we are saying this figure 236. So the formula that we are using there will lead us to say 236,000. We subtract 89,800, and then also subtract 47,200. So here, when we do that, we are supposed to get 99,000. 99,000. So this becomes our figure that we are looking for the disposal at carrying value, 99,000. So that answers the second part of that question. So we can go down again to check after that what do we have. After that we have so we are now on this one. This is the figure that we got to calculate the proceeds of fixed assets sold, because it was sold at carrying value. So that's the figure for carrying value, 99,000. So 99,000. is the response for that 3.1.3. Then we go to the notes now. The notes, we have got the issued share capital at the end of the year. So to get the issued share capital at the end of the year, we need to prepare that note of ordinary share capital. So obviously, we need the balances at the beginning. That's the balance that we are going to start with in the ordinary share capital note. Let's see, where do we have those balances? We go back to the question, check those balances. It means here we don't have again. We check again. Yeah, it's here. If you come here now, we have some explanations here. Here. Dub Safes Limited is an authorized share capital of 1,000 shares. We are not concerned about this one. The next sentence, 625,000 shares has been issued on 31 March 2021. So this is our opening balance in the form of number of shares that were there at the beginning. And then these shares were at an average price of 3 Rand 20. Remember, I said the average share price is the one that we apply in the ordinary share capital note. So to get the value now at the beginning, we are saying this number times the value per share, then we get the value at the beginning. So these are the figures that we are going to start with. We can go to our ordinary share capital note there. Right. So this is our ordinary share capital note on 3.2.1. Then we have got our opening balance there. This column, we are going to put the number of shares that we have at the beginning. Remember, we have 625,000. So we can show the authorized. We can start by showing the authorized. Remember, the authorized share capital is just shown as a disclosure procedure, but doesn't affect any calculation. So we have got 1 million that has been authorized. 1 million ordinary shares. Ordinary shares at 1 Rand each. Right. Then this number of shares, we put it here, though we put here 1 million. So we are just showing that that's what we have. And then the value, if you calculate there, we also get 1 million here. So this is the value. So here amount is in rands. Then we now go to the issued now. So on the issued, remember, we have 625,000. So this one, obviously, it's not going to affect the calculation, so we can just maybe close it. The 625,000 shares that we have at the beginning. This is balance. Balance at the beginning. At the beginning, the price per share now we are given there is 3 Rand 20, so it's 3.20. So now to get the value here, we are saying 625,000. We multiply by 3 Rand 20, and we get 2 million. So we have 2 million here. So that's what we have. And then we check again any adjustments in terms of any shares that were issued, any repurchases. This is what we can see there. Then we, right, on item 2, that's where we've got a repurchase. After considering the financial implications that a buyback of shares entail, the director decided on 1 January 2021 to repurchase 4% of the shares currently in issue. These shares were repurchased at 4 Rand 50. No entries have been made for this transaction. So we are seeing they were issued at 4 Rand 50, but we are not concerned about the amount, total amount that it was repurchased. When we are in the ordinary share capital note, we are concerned with the average share price. So we are going to use the average share price to value those shares, but we are told that it's 4% of the shares currently in issue. So we go back there. The shares that are currently in issue are the issued share capital. The number of shares of issued share capital are the shares currently in issue. So we are going to say 4% of the issued share capital. So we go there to our answer section. Remember, it's 4%. Here, so we see the number of shares that we have are here, 625,000. So we need 4% of 625,000. So when we say 4% of 625,000, so maybe we can just indicate here, if you say 0.04 times 625,000, then you get the number that was repurchased. When you do that, you are supposed to get 25,000. So we have 25,000 shares that were repurchased. So this is, remember, whenever there's a repurchase, there's an outflow of cash. So we show it as a negative in these notes. Even if you are in the retained income notes, the excess in terms of the repurchase price over the average share price, the excess, we also show it as a negative in the retained income note. So here, 25,000 on the quantity of the shares, number of shares, we show it as a negative that they are going out. And here we now summarize with the description of what is taking place there. There is a repurchase. There is a repurchase of shares, repurchase of ordinary shares. We are using the average share price 3 Rand 20. So that's what we have in terms of that repurchase. So in that case now, we need to multiply 25,000 by 3 Rand 20 to get the total of the repurchase. 25,000 times 3 Rand 20 there, you get 80,000. So here now 80,000. And obviously we show it again as a negative. So if you check in the question, there's nothing that transpired in terms of issue of shares. We only have that repurchase that took place. We go through everything. We don't have anything in terms of issue of shares. If we had an issue of share, we are supposed to again to indicate that there was an issue of share that took place. But when there's an issue of share again, the calculation of repurchase average share price might change if there was an issue of share that took place before the repurchase year. We are supposed now to calculate the average share price at fresh. We are supposed now to add the number of shares that we have, and it becomes the denominator. And then we add the value of shares that were there before the repurchase, which means the value that we had at the beginning plus the shares that were issued are there to become the numerator. Then we say the total number of shares that were there before the repurchase into the total value to get the average share price. Then that's the one that we use now for repurchase. But here we don't have any shares that were issued, so we are not worried too much. So that's what we have. Then we can now find the balance now. We can as well find the balance this side, and we also find the balance this side. So here again, we are going to say 625,000 minus 25,000, and we get 600,000. So these are the shares that we have at the end. And then the value, we are going to say 2 million, minus 80,000, we get 1,920,000. So this is now ordinary shares in issue. Ordinary shares in issue at the end. We know that it's still they are still in issue at that average share price of 3 Rand 20. So that's what we have in terms of the ordinary share note there. Then we can now move to the next one, which is the we see the next one is now the trade and other payables notes. So here we are going to the figure that we are going to start with is the figure for trade creditors, and in the question, it's not given, but it's pre-entered in the answer section as 53,000 for trade creditors. Then we are going to look for any adjustment that is going to affect the trade creditors. So we can go back there in the other section there and look for that item that we have. Right, if you come to item 4, let's come to item 4 here. So you are supposed to go through everything in terms of the additional information that you are given and try to see if there's anything that is affecting trade creditors. Remember, when we sell goods on credit, or sorry, on credit, that's when we are going to create these trade payables or creditors. And when those creditors return goods to us, it's going to reduce the amount of the creditors or trade payables. So we need to subtract the returns from the total figure of creditors that we have. So those are some of the adjustments that might affect the trade creditors figure. So we need to go through everything to try to see. But if you go through everything, you're going to see that there's nothing that is affecting. We only have here on item 4 that is saying 2 surfboards with a cost price of 5,500 each were returned to the manufacturers. Star Safe Designs, as they were damaged in transit, a debit note was issued. So these were creditors that we bought goods from. So these are now being returned. So when we return them, they are going to reduce the amount of creditors that we have. So that's the scenario that we have. Remember, these creditors are in our books. This is the creditors account. They will be having a balance on the credit side there. So when they return the goods, the source document that is issued is called a debit note. We are going to debit here in their account to reduce the amount there, so that they returned. We now have the goods in our business. So we are being told that there were 2 5,500. So 5,500 was each, and there were 2. So it means total now is 5,500 times 2. So if you calculate the 2, you get 11,000. So that's the figure that you are going to subtract from the figure of creditors. And remember, I said that figure for creditors is pre-entered. We are given it as 53,000. So here we are going to start with the figure for trade creditors. And it's pre-entered as 53,000. And then we are going to subtract 11,000 for the returns. And then we get a net figure for 42,000. Then we are also going to look for other payables that we might find in the question. We can check there. Right, we can go down the we can go down, check for any payables. We see now we have got here a new employee, Elisa, was omitted from the February 2022 salaries. Was omitted from the February 22 salaries. Journal era. His salary details are listed below. His salary details are listed below. So we have the issue of remember, we have got UIF, which is being said is 1%, 1%, and this 1% is being directed to when you're calculating UIF, we say 1%, we say percentage that we are given, and we multiply by basic salary. So our basic salary there is 14,500. So basically, you are saying 0.01 is 1%, and then we multiply 14,500. So when you calculate that one, you are going to get 145. But then this UIF also, there is the UIF for the employer. Safe Limited, as the employer, contributes 1% of the UIF again. So it means this one is for Elisa, and then for the employer also, we have also 145. So it means we've got 145, which is appearing twice there. So what it means now, for the figure of UIF, we are going to add 145 and add again 145. So that's what we have there. We go to our answer section and enter that figure for UIF. So when you come here now, we are saying UIF for UIF. So this figure again, we are given it as 1,160, the one that we have that is pre-entered, and then we add the 145 for the employee and the 145 for the employer, and then the figure that we get there is 1,450. Right. And also we have got SARS in the form of pay as you earn pay. SARS in the form of pay as you earn, and the figure that we are given that is pre-entered is 10,600. And then we need to see the one that was omitted is how much. Go again there. So the one that was omitted is this one, 2,610. So we add 2,610 to the figure that we are given there. So here we are now saying plus 2,610. And obviously there, if you add the two, you get 13,000. 13,210. Then we check other adjustments that we can have. Remember, if we have an income paid in advance, we are supposed to put it there. And if we have any accrued expense, we also supposed to put it there. Then we come there, we check. We are being told that a further 2,500 is still owed to the auditors in respect of their fees. So this is an accrued expense, 2,500. And also we have a basic salary here also, which was also omitted. Remember, we adjusted for pay as you earn, and we adjusted for UIF. So it means we are supposed to add this figure that we have to this figure that we have to get the total accrued expense. So accrued expenses fall under the current liabilities, and we put them under payables, other payables. So here we are just going to summarize that one. Let's just recheck the figure that we have for salary. It's 14,500. We have accrued expense. We are saying it's 14,500. Then we add the 2,500 that we have. So if we add the two there, let's try to add that one. 14,500. Then we add 2,500. Then we get 17,000. We get 17,000. And then after that, we also check other items that can be there. We check for income received in advance. Income that has been received in advance. We go there. There's an issue of rent received. If you still remember when we are going through, there's an issue of rent received. We can just maybe check where the explanation is in terms of rent received. Right. Right. That's what we have in terms of rent received. They're saying same Safe Ski Limited has rented the storeroom from Dubs Safe Limited for 850 per month since December. 850 per month since December. So what does it mean? What does it mean now? We now count the number of months that we have from December up to the end of the year. Remember, the year is ending. The day where the year is ending, we can find the date on the beginning of the question. We can recheck where the question is starting. The year is ending here, 30 March year. So on March 2022, that is ending the end of March 2022. So we count the number of months that we received that rent from December. They're saying 1 December. So for December, it was received. Then January, February, March. We have 1, 2, 3, 4 months. So this one is 4 months. Then we calculate now how much was supposed to be received there for those 4 months. 8 times 850. And we get, when we calculate that one, let's try to calculate that one. 4 times 850. You get 3,400. You get 3,400. So this is the rent that was supposed to be received in those months from December to March. And then we check the actual amount that was received. We have to check the actual amount that was received. So what it means now, it means this 3,400 is the amount that is supposed to be for rent income, for rent received under other income in the income statement, 3,400. Then if you look in the question, we would nowhere that we are told how much was paid. So we just assume this is the amount that was supposed to be paid, uh, that was supposed to be received for rent income. So we're going to put this one in the income statement under other income, and it's not going to affect the trade payables here. But if you come here on number 5, I say Nordic is a tourism company which brings tourists into South Africa from Norway. They use Deb Safe Limited to provide all their safe lessons. On 21 March 2022, that is the end of the year, Deb Safe Limited received a check from Nordic in full payment for 2 groups who received lessons as follows. So what it means the one that was receiving lessons from Deb Safe is Nordic Nikki, but we have got another company that is appearing there on that one, and you see the date of the lessons is 7 04/2021, which means it's after the year end. So it means these lessons are for lessons that are going to take place after the year end. So the payment that is going to be made for this 4 is going to be a prepayment. So remember, these lessons are generating income in the company. So this is income that has been prepaid. But for Nordic, we are seeing that the dates are in line with the year end, 21/03/2022. So they are not a prepayment; they are for that period. So remember, prepayments should not be adjusted for that period. So if it's an income, we take it as a current liability because it doesn't belong to that period. We received it, but it doesn't belong to that period. So that's why we take it as a liability, right? So it means 4. Remember, each lesson is 450. Stated there. If you go on top there, we've got something that is stating in terms of the income that is received per lesson. Here there's if we go back, let's go and check the rate per lesson that is going to receive. If you come here, we are seeing it's stated here. It's 450 per lesson. 450 per lesson. So for those 4 that are being paid in advance, or the income that we are being received in advance, we go there to multiply by 450. So there are 4. So if there are 4, we say now 450 times 4. And if we multiply that one, we get 1,800. So this one is going to be our income prepaid that we are going to put there in our trade and trade payables. So if you come here, we now have the figure for income received in advance. So basically, how we got it was say 450 times 4, and then we got 1,800. So that's what we have. We finished all the payables that we have. So we add everything that we have in that column. We add everything that we have in that column, and let's try to see what we have there. We have 42,000, and then we add 1,450, and then we add 13,210, and then we add 17,000, and we add 1,800. So the figure that we get there is 75,460. 75,460. So you can recheck also with your calculations if these are correct. But basically, we add what is this column, the total that I got here, 75,460. So that's one represents the total for trade and other payables. So that is what we gave, guys, in terms of this video. A video for the income statement or statement of comprehensive income will come later. So stay tuned for more videos to come. With that, I will meet again in the next video. Thank you for listening.